So today we shall be looking at capital gain tax. Capital gain tax is the topic we want to look at today. Capital gain tax. In my first lecture, when I was doing introduction to tax, I talk about direct tax. One of the direct tax I mentioned is company income tax, personal income tax, capital gain tax. So today I'm going to look at capital gain tax. Please try to mute your audio while class is going. Every diet for advanced tax question on capital gain tax normally come out. 20-mark question, sometimes 15-mark question on capital gain tax. Capital gain tax is just like hydrocarbon tax. Hydrocarbon tax, every diet, it normally come out. Likewise to capital gain tax. So capital gain tax was introduced in Nigeria in 1967. That was when capital gain tax was introduced in 1967. What do we understand by capital gain tax? Capital gain tax is the tax imposed on gain arising from disposal of tangible assets. Let me come again. Capital gain tax is the tax imposed on gains arising from what? Disposal of tangible assets. The word tangible asset means fixed assets. The word tangible asset means fixed asset, which can be tangible or intangible. When you make a gain from disposal of fixed assets, you need to pay a tax called capital gain tax. There are some fixed assets, when you buy them, even after using them for some time, you still want to sell them. You will sell them more than the price you buy them. You purchase them. Example of such fixed assets is land. Land appreciates in value. Take for instance, in Lagos, 20 years ago, 30 years ago in Lekki, if they want to sell land in Lekki about 30 years ago, 25 years ago, 20 years ago, maybe they are selling land 25 million per plot. Most of the owners, most of the landlords in Lekki, when they buy land in Lekki 25 years ago, 30 years ago, they buy it at a cheaper rate. Look at it now. If you want to sell a plot of land in Lekki phase 1, in some area, a plot of land in Lekki phase 1 is going for about 600 million, 1 billion. Can you imagine? So when you make a gain on disposal of fixed assets, you need to pay a tax called capital gain. How do we know you make a gain? Take for instance, I have a land. I bought the land 15 million 10 years ago. So a daughter wants to get admission in university in UK. I have to sell the land. I sell the land about 65 million. That means the difference between the sales proceed and the cost of acquisition is the capital gain. I bought the land 15 million. I now sold the land 65 million. What is the difference? The sales proceed and the cost of acquisition. What is the difference?
50 million.
50 million. I've made a capital gain of 50 million. I'm going to pay capital gain tax of how much? 10% of 50 million, which is 5 million. I'm going to pay it to government. Can you imagine how much I've made a gain of 50 million? Government is asking me just to pay 5 million. Is it too much? Is it too much? No, because I've made a gain already. At the end of the day, if I minus the tax I pay to government, I'm going on with 45 million extra. That is what capital gains entail. It is a tax imposed on gain arising from disposal of chargeable assets. When chargeable assets, fixed assets increase in value, when you make a gain, you need to pay a tax called capital gain. Now, administration of capital gain tax. Who administer capital gain tax? So, administration of capital gain tax. How do we administer capital gain tax? Who is responsible? Which tax authority, relevant tax authority responsible for collection of capital gain tax? The administration of capital gain tax depends on the nature of the transaction. If the gain is made by individual, the tax authority responsible to administer, to assess, to collect the capital gain tax will be the State Board of Internal Revenue. But if the gain is made by a company, corporate organization, the relevant tax authority that will assess the capital gain tax will be the Federal Inland Revenue. So, capital gain tax for a transaction made by an individual will be collected by State Board of Internal Revenue. While for a transaction made by a company will be collected by Federal Inland Revenue. Basis of assessment of capital gain tax. Capital gain tax is assessed to tax on actual year basis. Capital gain tax is assessed to tax on what basis? Actual year basis. That means if you make a gain on disposal of assets this year, 2025, you are going to pay the tax in this year, 2025. If you make a gain on disposal of assets this year, 2025, you are going to pay the capital gain tax in this year, 2025. That means capital gain tax is assessed to tax on actual year basis. Persons liable to capital gain tax. Who are the persons or taxable persons relating to capital gain tax? Who are the taxable persons relating to capital gain tax? Number one, individual. Individual, they are liable to capital gain tax once they make a gain from disposal of fixed assets. Number two, partners. In a partnership business, if any of the partners dispose fixed assets, we will pay capital gain tax. Trustees, we also pay capital gain tax. All companies too. Any company that dispose capital that dispose an asset that make a gain, we pay capital gain tax. Disposal, we mentioned disposal. What is meaning of disposal? According to Section 6 of Capital Gain Tax Act, disposal of an asset simply means when any capital sum is derived from sales, lease, assignment, compulsory acquisition, or any other disposition of asset, notwithstanding that no asset is acquired by the person paying the capital sum. What this section is saying now is disposal is deemed to be taking place when you have received the capital sum. You have received consideration for that asset. If you have not received money for the asset, you have not sold the asset under capital gain tax. We cannot say when you sell an asset on credit under capital gain tax, you cannot say you come and pay capital gain tax, even though you make a gain and the buyer promised to pay later. No, we, the tax authority, we only recognize disposal only when the capital sum is received. So what are the circumstances where disposal is deemed to have been taking place? Number one, when the capital sum is received by way of compensation for any loss of office. When you receive compensation for loss of office, you receive money. That means disposal has taken place. You need to calculate capital gain tax. When compensation is received under policy of insurance too, disposal of taking place. But the question is, are we going to compute capital gain tax on that or not? It depends on the transaction. When you surrender your rights of an asset to a party, you receive a capital sum for forfeiture of your right or surrender of your right, disposal of taking place. When capital sum is received as consideration for use or exploitation of any asset, that means disposal of taking place. So these are the conditions where or circumstances where disposal have taken place. When you receive compensation for loss of office, when you receive any capital sum under policy of insurance or damage or injury suffered, when you receive a capital sum for surrender your rights, disposal have taken place. When you receive capital sum in consideration for the use or exploitation of your assets, which is patent right, copyright, royalty, disposal have taken place. So when a capital sum is received in connection or arises from trading, profession, vocation, disposal have taken place. So that is it on disposal. The next area we need to look at is allowable expenses and disallowable expenses of capital gain tax in Nigeria. Allowable expenses and disallowable expenses. What are those expenses that is allowed if you want to compute your capital gain? The general formula for computing capital gain is to say your sales proceeds less the cost of acquisition, the cost that you use to acquire the assets. You get your capital gain and you compute your capital gain tax. However, there are some expenses you incur while selling the assets, like valuation fee, agency fee, advertisement fee. Those expenses, if you don't incur it, there is likely tendency that you may not sell the asset. So those expenses, they are allowed under the tax law. How do you treat those such kind of expenses? You need to remove them from sales proceeds. Any expenses incurred for the purpose of sales of the asset have to be removed from sales value so that your sales value will reduce. You know, when your sales value reduces, your capital gain will reduce. That means your capital gain tax too will be reduced. Hope you understand. Do you understand? Hello, do
Yes,
you
sir.
understand?
Yes, sir.
Okay.
Hello, sir.
Yes, I can hear you.
Take for instance, what of like if you receive some amount of money, maybe on rent, is that also disposal have taken place?
No, that
Okay.
one, but disposal have not taken place. Disposal have not taken place. Now, let's look at allowable expenses under capital gain tax. Number one allowable expenses is cost of acquisition. Cost of what? Acquisition, which is purchase price. Cost that you use to purchase that asset. When you buy that land 5 years ago, the cost that you used to acquire the land. Another allowable expenses, improvement cost, only exclusively and necessarily incur. When you buy that asset, for that asset to be useful or to protect the asset, some costs you incur at the point of purchase of the asset, like perfection of document, while you are buying the asset, perfection of agreement, or installation of gates to protect the asset. All such kind of things, they are improvement costs. They are also allowed. Another one is incidental cost of defect. Another one is cost incurred will exclusively and necessarily incur in establishing, preserving, defending the owner title to a right over the asset, which is legal cost that you incur while you purchase the assets. All those legal costs you incur while you purchase the assets is an allowable expenses. They are allowable expenses. Another allowable expenses is incidental cost of disposal. Another allowable expenses is what? Incidental cost of disposal. Incidental cost of disposal means selling expenses. Incidental cost of disposal means selling what? Expenses. Why disposing the asset? Why selling the asset? Those costs you incur at that time, they are incidental selling expenses. Number one, valuation fee. You need to call professional valuer to come and value the asset so that you can know the price you sell it. It's an allowable expenses. Legal fee. You need to involve lawyer to do an agreement for the purpose of sales. It's an allowable expenses. Accountancy fee. You need to involve accountant that will help you calculate the value of the asset. So they are allowable expenses. Stamp duties paid while selling the asset, they are allowable expenses. Advertisement cost to find seller, to find buyer of the asset is an allowable expenses. Agency fee, agency commission, estate brokerage fee is an allowable expenses. So all these are the allowable expenses for capital gain tax. What are the allowable expenses for capital gain tax? Disallowable expenses for capital gain tax. Disallowable expenses for capital gain tax. What are the disallowable expenses for capital gain tax? Number one disallowable expenses on capital gains is some are computing profit or loss of a trade for purpose of income tax are not allowed. under section 14 of the above. What this one means is that all those allowable expenses under company income tax, under petroleum profit tax, under personal income tax, that you have used them as an allowable expenses for you to get how much you are going to pay for your company income tax, how much you are going to pay for your personal income tax, how much you are going to pay for your petroleum profit tax. You cannot come and use them again under capital gain tax. They are disallowed under capital gain tax. Example, rent of a building, printing and stationery, telephone and postage, salaries and wages. You know they are liable under company income tax and personal income tax. Since you have allowed them under there, if you see them while computing capital gain tax, you disallow them, you will not use them. Hope my point is clear.
Yes, sir.
Another disallowable expenses is insurance premium on the assets are not allowable. When you buy an asset, land, motor vehicle, you insure the asset, you now pay insurance premium. That premium you pay is not allowed under capital gain tax. You cannot add it as part of the cost of the assets. You cannot do what? Add it as part of what? Cost of the assets. Higher purchase interest, where the chargeable asset was acquired on higher purchase. Higher purchase interest, where the chargeable asset was acquired on what? Higher purchase. You buy an asset on higher purchase. The total price you pay is 500,000. 3 years later, after finishing paying the higher purchase, you want to sell the asset. You now sell the asset 800,000. If we want to compute your capital gain tax, we can't say 800,000 minus 500,000. That 400,000 is higher purchase price. It includes interest. The question we ask is, how much is the cash price of that asset? We will only recognize cash price as the cost of acquisition. We will not recognize higher purchase price. We will not recognize the higher purchase price. You know, higher purchase price consists of cash price and what? And interest. And interest. Take for instance, when you buy an asset on higher purchase, you pay total sum of 500,000. Out of the 500,000, the cash price is 400. The interest is 100. 3 years later, you want to sell the asset. You now sell the asset 800,000 or 700,000. If you want to compute your capital gain tax, we will say 700,000 minus 400,000, which is the cash price. We can't say 700,000 minus 500,000. We will not recognize interest because interest is disallowed. Higher purchase interest is what? Is disallowed. So that is that. Another one, bad debt in case of default payment by the buyer. If the buyer did not pay finish, bad debt in case of default payment is not allowed under capital gain tax. What is the rate of capital gain tax? What is the rate of what? Capital gain tax. What rate do we use for capital gain tax? Presently, the rate of capital gain tax is what? 10%. Starting from 1st of January 1996, When capital gain tax was enacted into law in the 1970s, I mean 1960s, the rate then was 20%. It was 1995 December that they changed the rate from 20% to how many percent? To 10%. Since 1995 up to date, the capital gain tax rates still remain 10%. Though in the Finance Act 2023, there was an amendment to capital gain tax, introduction of cryptocurrency as part of capital gain tax, digital asset, but they did not amend the rates. Me, I was thinking then that maybe they need to review the rate upward to like 20%, but they did not amend the rate. Even the Tax Reform Act they are deliberating on presently, still silent on the rate of CGT. 1994 to date is almost 30 years. Don't you think the rate needs to be reviewed? Eh? There is need for the review of the rates, but they have not reviewed the rates. Now, that is rate of capital gain tax. Let's look at capital gain tax return. And what is the penalty if we fail to file capital gain tax return? What is the penalties? Capital gain tax, the return are filed twice in a year. Capital gain tax return are filed twice in a year. Transaction than 30th of June. Why transaction from 1st of July to 31st of December, the return must be filed not later than 31st of December. Hope this is clear.
Hello, sir.
No, sir. Take that again.
I can hear you.
Okay, can you please take that again? The filing. I think my network went off briefly.
Okay. I said capital gain tax return can be filed twice in a year. The first return must be filed 30th of June. And the return filed 30th of June, we covered capital gain tax transactions that occur from 1st of January to 30th of June. That means if you sell an asset May 15, you must pay the capital gain tax not later than 30th of June. But if you sell an asset August 14, the capital gain tax return and payment must be made not later than what? 31st of December. Do you understand? A transaction, if the sales of assets, disposal of assets occur from January to June, you must pay the capital gain tax not later than 30th of June. But if the transaction occurs from July to 31st of December, The capital gain tax must be paid not later than 31st of December. Oh, this is clear now.
Please, sir.
Yes, thank you.
Please, sir.
Yeah.
If the transaction takes place on 30th of June, how realistic is it to pay the capital gain tax that same 30th of June, sir?
Yeah, that's how you understand. I know in practice it's going to be hard if the transaction takes 30th of June. How is it going to be? But in that case, 30th of June, what the law said is any transaction that occurs from 1st of January to 30th of June must be paid not later than 30th of June. Why do you have to wait for you to do the transaction 30th of June? Hello?
What if that is the date? Maybe say a customer come around for the
Yes. Since you know now that you need to find the customer, okay, don't pay today, come and pay tomorrow. Do you understand? You need to know that the transaction does occur 30th of June so that you will not go against the law. Do you understand?
Yes.
Do you understand?
Yes, sir.
So, tax is law. Tax is law. Is law. So we need to follow the law. We, the tax practitioner, we follow the law. So if you fail to file return, what is the penalties? Failure to file return, we attract penalties of 10% plus interest at prevailing commercial rates. Failure to file return is going to attract a penalties of what? 10% plus interest at prevailing commercial rates. If you fail to file return, it's going to attract penalties of 10% plus interest at prevailing commercial rates. Now, computation of capital gain tax. How do we compute capital gain tax? What is the formula for computing capital gain tax? If you want to compute capital gain tax, sales proceed, you now less incidental selling costs, which is selling expenses. Who can give me an example of those selling expenses? As I mentioned earlier.
Commission.
Okay. Agency commission or agency fee. We also have valuation costs, advertisement costs. They are all incidental selling expenses. You less them. When you less them, you will get what is called net sales proceed. Net what? Sales proceed. When you get your net sales proceed, you will now deduct your cost of acquisition. The cost that you used to acquire that asset, you deduct it. If you have improvement costs, when you buy that asset, you incur some improvement costs too. It's part of the cost of acquisition, you deduct it. When you buy the asset, you incur some carrying costs. It's part of the cost of acquisition, you deduct it. When you buy the asset, you incur some legal costs. It's part of the cost of acquisition, you deduct it. Once you deduct your cost of acquisition, you get what is called capital gain. You will get capital gain. Once you get capital gain, on this capital gain, you can now apply capital gain tax of 10% on it. On this capital gain, you can now apply capital gain tax of 10% on it. Now, that is the formula for computing capital gain. This is the general formula for computing capital gain tax. That is the thing. Now, can we look at those assets or gains subjected to capital gain tax? According to Section 3 of the Capital Gain Tax Act as amended, what are those assets or gains subjected to capital gain tax? What are those assets or gains subjected to capital gain tax? Number one, incorporeal property. Incorporeal property. Incorporeal property, they are the fictitious assets, intangible assets, those assets that you cannot touch. They are not physical, they are intangible. Example, goodwill, copyright, trademark, patent rights. They are subjected to capital gain tax. When you sell your goodwill to another company, you pay capital gain tax. You lease out your trademark, you pay capital gain tax. Patent right, you sell it, you pay capital gain tax. Some of these incorporated property, most of them don't have cost of acquisition. They only have sales proceeds. The sales proceeds, you impose the flat rate of capital gain tax on them straight. The sales proceeds, you impose capital gain tax of 10% on them straight. That is incorporeal property. Another gain or asset subjected to capital gain tax is options. 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 What is option? Option means purchasing rights. Option means what? Purchasing rights. You have a filling station. You are one of the distributors of petrol. You have a filling station. Dangote refinery want to sell PMS to you. They now say you are a good customer since you have like 250 filling stations in the country. We are going to give you options. Instead of selling for you the normal price of PMS from Dangote refinery was about 950. I'll be 925 per liters or 920. So Dangote refinery now say, since you are buying in large quantity, we are going to give you purchasing right. If you can buy 200 trucks, we are going to sell it for you at the rate of 850 per liter. And you have that option to buy that 200 trucks within so dates. And you don't have money for the 200 liters. You have money for only 50,000 liters. What you can do, you can go and meet another filling station. Ask them to come and buy the option from you. The option given to you that with Dangote, you go and approach some other filling station. You know that Dangote will sell for them at the normal price. You will tell them that you have been given an option. They should come and buy with that option from you. If they buy the option from you, instead of those filling stations buying at the normal rate, Dangote is selling at 920 per liter, they will buy the option from you. They will pay you some commission. They will now go and use the option, your option, to buy it at 850 per liter. When you make that commission given to you by those other filling stations, you have made a gain already. That gain, you need to pay capital gain tax on it. So you need to pay capital gain tax on it. That is option. Another one, another asset subjected to capital gain tax. Debt. Debt. This one is most common to debt factorization. Debt factorization company, that is their major business. They will not pay capital gain tax. But you as an individual, you are not a debt factorization company. A company come and approach you that a customer is owing them money, but they need the money now. They are ready to sell the debt to you. They're supposed to collect 500,000 naira from the customer. But if you have 450,000 now, they will collect it from you. So that when the customer will pay, he's going to pay you 500,000. That means you have made a gain. That gain of 50, you are going to pay capital gain tax on it. You have made a gain on debt, you need to pay capital gain tax on it. Another one, any other currency other than Nigeria currency. If you make a gain on disposal of any foreign currency, you will pay capital gain tax. Another one, stock and shares. If you make a gain from disposal of stock and shares, you will pay capital gain tax. There was a time stock and share was excluded from capital gain tax computation, that if you make a gain on stock and share, you will not pay capital gain tax, as from 1998. But Finance Act 2023, which is effective from 1st of January 2024, now later reintroduce stock and share, that they are now subjected to capital gain tax. The only reason why stock and share will not be subjected to capital gain tax is when you make a gain on disposal of stock and shares and you reinvest that proceed in purchase of another shares within some certain time. Stock gain, such kind of gain will not be subjected to capital gain tax. Finance Act 2023 has now reintroduced that stock and share of any description is subjected to capital gain tax. The only condition Finance Act 2023 said stock and share will not be subjected to capital gain tax is when you sell your shares now, you use the proceeds, you have made a gain while selling the share, but you use the proceeds in purchase of another shares, you will not pay capital gain tax. So That is that. Another one, all qualified capital expenditure. All qualified what? Capital expenditure. QCE. Such as what? Plant and machinery, motor vehicle, furniture and fitting, land and building. When you make a gain in disposing any of these assets, you paid capital gain tax. Do you understand? Do you understand? Another asset subjected to capital gain tax is digital assets. When you make a gain from disposal of digital assets, you pay capital gain tax. What are the digital assets? They are the example of digital assets is online assets. Example of them, cryptocurrency, online gold, online crude, online commodity. Before, they are not subjected to capital gain tax. But Finance Act 2023 introduced them as part of those assets that will be subjected to capital gain tax. It was introduced by Finance Act 2023 as part of those assets that will be subjected to capital gain tax. We have talked about stock and shares too. They will be subjected to capital gain tax. Stock and share will be subjected to capital gain tax if the disposal of that stock and share, if you dispose stock and share that has a value of 100 million and above, they will be subjected to capital gain tax. The only condition that they will not be subjected to capital gain tax is when you reinvest the disposal value within 12 months, when you reinvest them in purchase of another stock and share, it will not be subjected to capital gain tax. So, ladies and gentlemen, we have listed all the assets subjected to capital gain tax. I can summarize them again. Number one of them is incorporeal properties, which are fictitious assets. Number two, option. Number three, any other currency other than Nigeria currency. Number four is qualified capital expenditure. Number five, debt. Number six, stock and share. Number seven, digital assets. So those are the assets subjected to capital gain tax. We can now look at assets that are exempted from capital gain tax. Those assets that are exempted from capital gain tax. Some, you can be asked, what are those gains exempted from capital gain tax? If they ask you gain arising from, if they ask you what are those gains subjected to capital gain tax, if you want to answer the question, you will say gain arising from disposal of incorporeal property, gain arising from disposal of option, gain arising from disposal of debt, gain arising from disposal of any foreign currency, gain arising from disposal of qualified capital expenditure. You understand my point? Hello?
Yes, sir. We are following you, sir.
Okay. Thank you very much. So, let's look at assets exempted from capital gain tax or gain exempted from capital gain tax. One of the assets exempted from capital gain tax is government security. If it is gain arising from disposal of government security, gain exempted from capital gain tax. Government security, if it is gain arising from disposal of government security. So, what are the government security? Who can give me an example of government security? Treasury bill, treasury certificate, development stock, bonds, they are government security. When you buy government security, you want to sell them, you now make a gain, you will not pay capital gain tax. Another one, gain made by local government authority. When a local government authority dispose an asset, they make a gain, they will not pay capital gain tax. Another one, gain accrued to charitable or educational institution of a public character. Gain accrued to charitable or educational institution of a public character, they will not pay capital gain tax. Another one, any capital gain on disposal of life assurance policy, you receive compensation as a result of life assurance policy, you will not pay capital gain tax. Why? Another one is what? Gain from disposal of medal or decoration won for honor, for valor or gallantry conduct. You represent Nigeria in an Olympic, you won a gold. If you win a gold, that gold, if you dispose it, you make a gain, you will not pay capital gain tax. You are a member of Nigeria Armed Force, you are one of those squad that went to fight Boko Haram, you now defeated Boko Haram. President want to give you an award, they now give you a gold award. That award, if you make a gain, you will not pay capital gain tax. Another one, any capital gain tax from disposal of chattel that is less than 1,000 naira. Your chattel, you dispose your gold, your jewelries. But if the value is less than 1,000 naira, you not pay capital gain tax. But if the value is less, or if the value is more than 1,000 naira, you pay capital gain tax. So, another one, compensation for loss of office that does not exceed 10 million. If you are giving compensation for loss of office, which does not exceed 10 million, you will not pay capital gain tax. But if the compensation for loss of office is more than 10 million naira, you will pay capital gain tax. Another one, any gain accrued to diplomatic bodies or diplomat, all those foreign embassy, American embassy, UK embassy, France embassy that are in Nigeria, anytime they dispose any of the assets, if they make a gain, they will not pay capital gain tax. One of the important ones we want to look at is gain from disposal of landed property. Gain from disposal of landed property acquired by a forced acquisition by any government in Nigeria, provided that the seller has not taken any previous step to dispose of the assets. What this one is saying is, one of the owner of the land, he has a land, a building in the main road. Government want to expand the road. They now write a letter. This your building. We need to demolish it because we want to expand the road. The road has to pass this land. Since you have CFO and you have all the necessary documents, they are going to acquire this land from you. Government will acquire it. That is forced acquisition. You don't have intention of selling it. But government look at it that you have all your documents complete. You have your CFO, you have all the documents complete. They will pay you compensation. They will acquire it from you. That money paid to you, you cannot pay capital gain tax on it because you don't have intention of selling the land unless we have an evidence that even before government come that they want to do road expansion, you have been advertising that you are willing to sell this land or this building before. In that case, you will pay capital gain tax. Compensation received for injury or damage suffered. When you receive a compensation for an injury or damage suffered while you are working, you don't need to pay capital gain tax on it. Another gain that is exempted from capital gain tax, when you make a gain while disposing a share, in the case of merger and acquisition, you dispose your share as a result of merger and acquisition, you will not pay capital gain tax. So those are the gain. If you dispose your shares as a result of merger and acquisition, you will not pay capital gain tax, provided that you use the money within 12 months to acquire another shares in another company. Provided that you are a member of that group of companies for at least 3. Can you hear me now?
Yes, sir.
Hello, can you hear me? Okay, sorry, the network is breaking. So we have looked at those assets exempted from withholding tax, from capital gain tax. We have looked at them. Now, let's look at another area under capital gain tax called connected persons transactions. Connected persons transactions. What do we mean by connected persons transactions? In connected person transactions, simply means transaction between two or more related parties. Connected person transaction means transaction between two or more what? Related parties. When two or more related parties do a business transaction, such kind of transaction can be referred as artificial transaction. Transaction that is not done at arm's length. In relation to capital gain tax, when two or more connected persons transact by selling assets between themselves, the price used by those two parties is not the ideal price, it's an artificial price. So we need to determine market value. What are the examples of connected persons? What are the examples of connected persons? Individuals, somebody like me, I'm connected to my wife. Employee is connected to A parent company is connected to the subsidiary. What we are saying in essence is, take for instance now, I have a land. I will sell the land to my wife, 20 million naira. When they want to compute capital gain tax, they now discover that the market value of that land is 40 million naira. You understand? That means transaction between me and my wife, because we are connected, we are related by marriage, is artificial. If they want to compute capital gain tax, they will not use the 20 million I sell it. They will use the market value to compute the capital gain tax, which is 40 million. That is what they will use, and minus the cost of acquisition, the cost I used to buy the assets. That is connected persons transaction. When connected person transaction happen, we need to determine the market value. The market value is what we are going to use as the sales proceed, provided that the market value is more than the sales proceed used by the connected parties. Provided that the market value is more than the sales proceed used by who? By the connected parties. That is connected persons transactions. And I gave example of connected persons. Who are the connected parties? I've gave example. I've gave them. A wife is connected to his husband. An individual is connected to his or her spouse. An employee is connected to his or her employer. A company is connected to another company in the same group of companies. Partner is connected to other partner in a partnership business. So that is connected persons transaction. So under the connected person transaction, we will look at an illustration. We look at an illustration. Let's look at example 1. Somebody should help us read. Oh yeah, example 1. Somebody should help us read the question.
Colbios Limited is a manufacturing company based in one of the major cities in Nigeria. In its bid to reorganize the business for future profitability and growth, the board of the company approved the underlisted transaction during the year ended December 31st, 2022. A motor vehicle which was acquired in August 2019 for 2,750,000 naira was sold to the general manager in October 2022 for 2,550,000 naira. The market value of the motor vehicle at the date of disposal was 2.9 million. Required. Compute the capital gains, if any, and capital gain tax for the transaction. The second requirement, state the dates when the tax liability, if any, is to be paid to the relevant tax authority.
Okay, thank you very much, my boss. The company acquired the motor vehicle at what is the cost of acquisition for the motor vehicle? What is the cost of acquisition? 2,750,000. Abi, they now sold it to who? They sold the motor vehicle to who? To the
General manager.
general manager. General manager is an employee of the company. Abi?
Yeah. Yes.
Is connected persons. Is connected with the company. Look at how much they sold it to the general manager. It's even less than the price that they buy it. And from the research, we are told that if they want to buy the assets in the market value, if they want to sell the assets, the motor vehicle in the market, it's worth how much?
2.9 million naira.
2.9 million naira. That means if you want to compute capital gain tax, our sales proceeds will be how much? What will be our sales proceeds?
2,550,000.
Sales proceeds, we are not going to use 2,550,000. We are going to use what?
2.9.
2.9, which is the market value. Do you understand? Because that 2,550,000, because it's a connected person, it's an artificial price. The general manager is working with the company. That price is not true price. Do you understand? That price that they sell it to the general manager is because that person is a general manager. He's working for the company. That is the reason why companies sell it at that amount. This is the real value it worth. So why computing capital gain tax? We are going to use in the sales proceeds, instead of us using 2.5 million, 2,550,000, we will use 2.9. Solution. Cowboys Limited. Computation of capital gain tax. For which year? When is the sales taking place? The sales was taking place in what? October 2022. That means it's for 2022 year of assessment, which is tax year. Sales proceed 2.9. Do we have any selling costs, selling expenses like agents, agent commission, cost of valuation? We don't have. That means our net sales proceed still remain what? 2.9. Less cost of acquisition. How much is the cost of acquisition? How much that they buy the motor vehicle? The motor vehicle was bought in 2019 at the rate of 2,750,000. That is the cost of acquisition. You less it. You get your what? Capital gain. Your capital gain is now 150,000. You compute your capital gain tax, 10% of 150,000. It will give us 15,000. That is your capital gain tax. Any question on this? Any question on this? I think this is clear. Hello?
Yes, sir.
Okay. You know the reason why I use 2.9. I want to ask a question. What if it was, hello?
What if the motor vehicle was sold to the general manager for 3 million naira and the market value?
Yes, that is the question I want to ask.
Okay.
The sales proceed is greater than the market value. Ladies and gentlemen, we use the sales proceed. We use the 3 million. You know, you are acting as a tax authority. Which one will give higher tax? Do you understand my point? If the motor vehicle was sold to the general manager, 3 million naira, you are going to use 3 million naira. Because that 3 million naira is even greater than the market value. It's okay. It will make you to pay, it will make them to pay more tax. It's okay. We are acting as a tax authority. Do you understand? That is my question before. Now, second question said, state the date when the tax liability is to be paid to the relevant tax authority. What is the due date that the capital gain tax will be paid? Who can tell me?
31st of December.
31st of December. Because the sales was taking place when?
October.
2022. The due date of payment will be 31st of December 2020 what? 2. Do you understand? So if you look at my solution, I write B part of the question. I said date of disposal October 2022. Due date for payment 31st of what? December 2022. Let's look at one more question on partial disposal. Let's go to illustration. I think I have a question on partial disposal. On connected person transaction, I want to look at, I have another question. If the question is not here, on connected persons transaction. The question is not here, but let's look at this question before we proceed to the next area we are looking at is partial disposal of fixed asset. But before we proceed to partial disposal, I want us to look at a direct question on capital gain tax. A direct question on capital gain tax. Question 4. Let's look at question 4. Question 4. Question 4. Question 4. Shuku Dememe Ezego Venture dispose of a building in Ojota, Lagos. The property was acquired in 2014 for how much? 3.2 million. The sitting tenant of the property finally vacates the property in January 2017. And security man and gardener were immediately employed to provide security and tied up the property until it was disposed in July 2017. The following details were extracted from the book of books and record of the company. Number 1, sales proceeds of the property, 9.6 million. Administrative cost for disposal of the property, 33,000. Insurance premium against risk damage of the property, 96,000. Depreciation of the property for 7 months, 110,000. 1,100,000. Security guard and gardener wages for 7 months, 140,000. Cost of renovation of the property in March, 425,000. Commission and fees paid to professionals on disposal of the property is 480,000. While transfer and conveyance fee is what? 160,000. You are requested A, compute the capital gains. B, compute the capital gain tax paid by Shuku Deme Ezego Venture. So this is a direct question on capital gain tax. In this question, which of the first item are we going to take first if you want to compute the capital gain tax? Which of the item are we going to take?
Sales proceed.
Sales proceed. How much is the sales proceed? 9,600,000. Can we all see that? Do you understand? Now, once you take the sales proceed, you will now ask your question. At the time of selling the asset, do we incur any cost for the purpose of selling the assets? So that I can less it from sales proceed. Who can give me an example of such costs I will less from sales proceed?
Advertisement cost.
Advertisement cost. Number one. Another one. Let's go down. Another one.
Cost of renovating property. Part of it.
Cost of renovation of the property. Where is cost of renovation of the property? That one will be added to cost of acquisition.
Okay.
It will be added to cost of acquisition. Another one is commission and fees paid to the professional. The agent that bring buyer, commission and fees paid to them. It will be less from sales proceeds. Sales agreement, deed of assignment too. When they do transfer, deed of transfer, it will be less from sales proceeds too. That means, look at our solutions now. AZGO Venture, computation of capital gain tax for 2017 tax year, because the sales was taking place in 2017. Sales proceeds is 9,600,000. Less advertisement costs. Selling expenses. Number one of them is advertisement costs. Number two is commission fee. Number three is transfer and conveyance fee. I will add the three of them together. Advertisement cost is 33,000. Commission fee is 480,000. Conveyance fee 160,000. If you add the three of them together, it will give you what? 600 and what?
673,000.
You minus the 673,000 from what? From 9,600,000. From 9,600,000. Once you minus that from 9,600,000, your net sales proceed is going to be what? 8,927,000. That is your net sales proceed. We go back to the question. How much was the asset was originally acquired when they acquired the assets? How much? 3.2. That means that is your cost of acquisition. The asset was acquired in 2014. Your cost of acquisition is what? 3.2. Aside from 3.2, what other costs that they incur to improve the life of the assets? What other costs that AZGO incur? Cost of what? Renovation cost. It will be added too. It's part of the cost of the asset too. Renovation costs. I will minus renovation costs. Those are the two major costs. Those are the what? Two major costs under your cost of acquisition. You will plus two of them. It will give you 3,625,000. When it gives you that, you will now minus it from your net sales proceed. When you minus it from your net sales proceed, what is your capital gain? 5,302,000. 5,300 and what? 2,000. In that case, your capital gain tax, 10% of 5,302,000. It will give you what? 520,200. Ladies and gentlemen, if you go to the question, you see insurance premium. Do we use insurance premium at all in the solution? Do we use insurance premium?
No, sir.
No. Why we did not use insurance premium? Because at the beginning of my lecture, I talk about allowable expenses and what? Disallowable expenses. At the beginning of my lecture, I talk about allowable expenses and disallowable expenses. What are the examples of disallowable expenses I mentioned? I mentioned that insurance premium is disallowed. You don't use it while computing capital gain tax. Do you understand? Do you understand?
Yes, sir.
Yes. Aside from insurance, which other costs we did not use and why we do not use them? Let's go to the question and check again. Which other costs we did not use and why we do not use them? Depreciation, we did not use it. Why? Depreciation is a non-cash item. It does not involve cash payment. In tax, we don't recognize depreciation as an expense. Abi? You understand? While you are computing your adjusted profit, you know depreciation is disallowable expenses. Abi? Under company income tax and personal income tax. Do you understand?
Yes.
Depreciation
Yes,
is not
sir.
allowed under the tax law. It's not allowed as an expense, so we cannot use them. Another one we did not use, security and gardener wages for 7 months. Who can tell me why we did not use it? Who can tell me why we did not use security and gardener wages? Because they are incurred on the building too now. Why we did not use them? I will show you the reason why we did not use security and gardener wages. I will show you the reason. Number one, disallowable expenses. I said any allowable expenses that is allowed that have been used for adjusted profit under what? Company income tax and capital gain tax. Rent, printing and stationery, salaries and wages, repair and maintenance. All those expenses, they are allowable expenses under company income tax and personal income tax. So they should not be allowed again under what? Capital gain tax. Example of them, of such kind of expenses, is security and gardener salary. Example of such kind of expenses is security and gardener salaries. Because security and gardener salary is allowed as an allowable expenses under personal income tax and company income tax. Why Ezego Venture is doing its personal income tax computation, you will have used that security and gardener salary as an allowable expenses. Do you understand my points?
Yes, sir.
So Ladies and gentlemen, this is where we are going to stop today. By next week, we started with connected party. We will start with partial disposal of fixed assets by next week. So today, so far, we discussed what is capital gain tax. We list the assets subjected to capital gain tax or gain subjected to capital gain tax. We also list the assets or gains exempted from capital gain tax. We also talk about basis of assessment of capital gain tax. Today we also look at connected transactions, and we also talk about administration of capital gain tax. That is what we look at today. So by next week, we continue from where we stop. Any question, any issue, any observation?